Let's get to our Wrap the Week segment. This is where we focus on the movements of the markets themselves and try to get our head around how the markets have changed from last week to this week. And, really, I would say it's not just about this last week, but about the last series of weeks. The last 4 to 5 weeks have been about an evolution from value over growth to growth over value, from small cap leadership to small cap laggardship, from breadth measures being mixed to breadth measures being more positive. There's been a lot of movement. And I think what you're seeing now is a lot of charts at really interesting places. When I'm thinking of things like banks and airlines, they've pulled back to ascending 50 to energy companies. They've pulled back to ascending 50-day moving averages. The question is, do those hold? And do those charts resolve higher, or do they fail? What you're seeing from the banks is that they're holding just fine and rotating back to the upside. That's impressive. What you're not seeing that yet is places like airlines. Delta reported earnings this week, not really bouncing off of support like others. So I think it's a group by group thing to see how these different charts are evolving. Overall, we'll look at what happened today, and then we'll focus on the weekly trends, and then we'll get into the Mindful Investor Live chart list and go through as much as we can, given our allotted time. Overall, the S&P finishing higher again, a new all-time closing high, 4185. And it's funny, it's how long ago we were talking about 3,700 and whether we'll be able to get above that key level, and look at how we're 500 points later, we're still pushing to the upside. Pretty much everything higher in terms of equity indexes, it was just scales of positivity. The strongest of the indexes we track here on our front page was the mid-cap index, up almost 0.8%. The NASDAQ, probably the weakest of the bunch, just above zero. The VIX is almost at 16, which is the lowest it's been in a year plus. Other asset classes, very quickly, let's look at today's move. Yields back higher. Yesterday came off pretty good, and that was a nice bounce in bond prices. Bond prices back down today. The dollar down as well, but just a little bit with the UUP below 25. Gold and precious metals back up. We're going to look at the chart of gold here in a little bit, because it's one of those, it's actually setting up in a pretty positive way. Gold we think of as sort of an inflation hedge. And when people talk about inflation concerns, but gold really isn't doing anything, my comment is I'm not seeing that. I'm not seeing people worried about inflation, or you see gold prices go up. You're actually starting to see that rotation higher, little swing highs, new swing lows, and that indicates some concerns about inflationary pressures going forward. Cryptocurrencies mixed. Bitcoin probably the most widely followed, down today, bouncing in the last half of the day, but overall nearing the 62,000 level from below here. Let's look at the week during the show. We're starting the clock last Friday, and we're going at the next 5 days, and we're seeing what's actually happened with these different asset classes. We'll start with the S&P 500. You'll see a cluster of lines here. So the S&P, the NASDAQ, and emerging markets are all kind of on top of each other right around here. This is around 1.4% or so, and that was a return on the large cap index, the S&P. What outperformed stocks? Gold up 1.9%. How many times in recent months, if not years, have we talked about gold outperforming the S&P? It's happened. It's happened today when we look at the last 5 trading days. Two things, definitely outperformed: crude oil and Bitcoin, both of which up over 6%. Looking at the last 7 days or last 5 trading days, going back to April 9th. What has underperformed stocks this week? Bonds, just a little bit, up around 1.3%. Small caps only up 1%, and this is that continued rotation, away from small cap leadership we've seen continue today. And then the dollar is the only one out of all of these major ETFs we're following that was actually down 0.6%. So that stronger dollar rotation is one of those things that had been certainly emerging. This week was a little of the opposite. You've seen bond prices higher, rates lower, the dollar lower, and most other things net positive over the last week. Let's continue our Wrap the Week segment looking at the Mindful Investor Live chart list. If you've not seen a Friday show before, this is a chart list that I keep updated every week. We review it on the show every Friday. If you've not seen it before, go to the articles tab at the top of your screen, go to my blog, which is called The Mindful Investor, and you'll see a link at the top that says Live Chart List. This will get you back to the chart that we're going to review here. So we start off with the S&P market trend. This is looking at 3 different time periods, all using weekly data. So it's the long-term, medium-term, and short-term models are all based on different weekly exponential moving averages. And another time I can get into more of the mechanics of it, but overall, the long story short, long-term, medium-term, short-term, all positive. The long-term model has been positive since June of 2020. The medium-term model had been negative from around mid-February, but turned back positive 2 weeks ago, 2 Fridays ago, turned back positive. And so that's a thumbs up. The short-term model has been positive since late February. So when all three of these are positive, again, it is not predictive. It's telling you what the trend has been up until today. But in general, I found when this model is green across the board, that is the time you should feel fairly comfortable getting into stocks and charts and ETFs that look attractive. This is telling you that thumbs up, you have the green light to explore and look for opportunities as warranted. When the medium-term model turned negative about 2 months ago, that told me to be a little more cautionary, to hesitate a little bit on looking at new long ideas, because there was a chance, a non-zero chance that the market would show material weakness from there. Really, it had not materialized. As you know, the S&P resolved to the upside, shrugged off some of the bearish divergences we'll look at in a moment. And at this point, the model is all positive. The daily chart of the S&P really shows this pattern of rallies and consolidations. And I think of this last year in sort of a series of impulse moves in the direction of the overall trend, sort of sideways moves. You have the first big move from the March lows up to the June peak. That was sort of one phase. You then had this pullback phase for about 6 weeks, where it was about 2 months, where you pulled back to the 200-day a couple times. You bounced above resistance, found support there, and then broke to new highs into September. Chapter 2 was this next phase where you have the sideways consolidation here. This is when things like financials and energy stocks and others out of nowhere start breaking out to the upside. The market overall breaks out of that consolidation phase in November and moves to new highs. And that's where 3,700 was the level we talked about for months, was really that magnet level for stocks. Since then, we've essentially had a pretty significant consistent rise, really haven't broken below the 50-day moving average with any consistency from that time. We've pulled back a number of times. Those have all been fairly attractive entry points during a long-term uptrend. And now we've had a couple weeks of really no pause in the uptrend. And anytime that happens, anyone who has managed money for any amount of time will have my reaction, which is I'm ready for a pullback, right? Pullbacks happen. If you have not pulled back in a long enough period of time, be ready for one. And it doesn't mean to sell things aggressively. It just tells you to be wary and look for signs of internal weakness. Look at stocks that aren't working and take some off the table there. Because here's the thing: if you're all in now and you don't have any cash for when the market does pull back, this is why institutions are looking to raise cash in this sort of move, because the problem is when the market does pull back 8 to 10%, which would happen at some point in the future, you want to have an opportunity to buy in on that weakness. And if you're still all in, you really don't have an opportunity to get into things that start to look really attractive. So the concern now is, where are you lightening up? Where are you looking for opportunities? And in general, I'd be in stocks that are working with improving relative strength. I'm leaning away from things that have not been working. That's the general thesis I would be on. The S&P is overbought right now. That has a lot of implications. We don't have time to go through all of that today, but I did record a video on my YouTube channel, which is called Market Misbehavior. Check that out. I posted a video this week about the overbought conditions and talked through how that relates to historical conditions and what you might want to expect going forward. So check that out if you didn't see it. The breadth picture overall is very supportive, but it depends on what group of stocks you're looking at. And in general, if you're looking at the largest stocks, the S&P, the mid-cap index, these advanced decline lines continue to make new all-time highs along with the market. And again, the market going to new highs with these advanced decline lines making new highs is the sign of a healthy market environment. That's kind of what we're seeing right now. As long as that persists, as long as that pattern continues, there is very little you should be worried about. What I'm looking at, though, is that the small cap advanced decline line has not quite confirmed that, has not broken to new highs. The microcap index, we don't really track a microcap AD line. I think that might be a sketchy data set to probably even try to put together. But if you look at the microcap index, the IWC, it's not confirming a new high recently. So the S&P making new highs, but other indexes not, is where you can, that's maybe a bit of a concern. That's something to watch. So whether or not the S&P the small cap advanced decline line can make a new high next week would be an interesting thing to watch for. I'm open to the discussion on new highs. I've heard some people looking at this chart here saying, as the S&P is going higher, there are less and less new highs. I'm not necessarily seeing it that way. I'm seeing the S&P go up, and there's a healthy amount of new highs. These green bars up here tell you that on a good up day, when the S&P is closing higher, it's about 15 to 20% of the index that of the S&P 500 that is making a new 52-week high. That seems pretty positive to me. I see that as being consistent with previous bull market phases. I don't see that as a negative. The S&P going higher, but it's only like 5% of the S&P making a new high. That for me is more that's a check in the concern column. I'm not seeing that here. I'm seeing plenty of new highs. This isn't updated for today just yet, but Thursday's close, you had 18% of the S&P making a new high. I can't see that being a net negative by any stretch. Also, you're seeing strength and again, these are all breadth measures using the S&P 500. That's why they look so positive. If you look at the percent of S&P stocks above their 200-day, it's about 96%. Look at the percent of S&P stocks above their 50-day moving average, it's about 93%. Those are both pretty positive numbers, right? S&P making new highs. And, what's happened is back here at the beginning of March, when we pulled back, only 50% of the S&P still was above its 50-day moving average. This is when the S&P itself actually closed below it for a day. Now, 93%, almost the entire S&P has now recovered, which means 43% of the S&P has gone back above its 50-day moving average in the last 6 weeks. That, to me, seems like an overall positive signal. Let's look at sentiment a little bit here. So if you're looking at the AAII survey, these are individual investors. This is survey data. So literally, investors are asked, are you bullish, bearish, or neutral on stocks in the next 6 months? And basically what this is telling you is it's over 50%, which for me puts it in the euphoric category. It's certainly elevated. It has gotten much higher, and at times it's gotten up to 60 to 70%. This is back in 2003. If you go back that far, you'll see it up that high. So it's not the highest it's ever been, but overall it's telling me sentiment is stronger than average, and I should be looking for signals that the trend is exhausted. I'm not seeing that signal yet, which is the sign of trend exhaustion. Active money managers, this is the name exposure index, have gone from 50% long to almost 100% long in the last 2 weeks. It's a pretty big swing in that indicator over a 2-week period, and indicates that money managers essentially have gone from tapping the brakes to stepping back on the accelerator and pushing to the upside. Ridex funds, by the way, are at the highest level, really the lowest value that they've been in history, which is essentially saying it's an extreme level of bullishness. We don't have time to go through all the ratio charts, but I'll just highlight a couple very quickly before the break here. Number one, semiconductors making a lower high there on the relative strength, the relative performance of semiconductors versus the S&P. Charts like NVIDIA are making new highs. That's great, but the average semiconductor stock is not. That's an area of concern. That's sort of a bellwether group, and in general, you want that group to be doing better rather than worse. Other trends have really maintained their trends. Small caps continuing to underperform large caps. That's the chart we just flipped through here. The equal weight S&P underperforming the large cap S&P, and growth back to working over the last month. We really haven't seen a rotate back into value in any meaningful way. That's something I would potentially be looking for into next week. Do we see a return of rates increasing? Do we see a return back to the value trade?
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.